One needs financial markets to channelize the savings of an economy towards productive and efficient sectors. This is often referred to as financial intermediation. Conventionally, banks have played this role. However, financial intermediation by banks is fraught with issues such as bureaucratic hassles and principal agent problems. In contrast, financial markets allow investors to directly participate in the process of choosing the best investments themselves and avoid issues such as principal agent problem. To this end, an economy needs efficient and liquid markets. In this lesson, we'll discuss what is an efficient and liquid market. We'll also examine the risk preferences of individual investors and how these risk preferences affect their investment decisions. We'll introduce and discuss various market microstructures and provide theoretical underpinnings to the financial market operations. We'll conclude the discussion with a very important market microstructure, that is limit order books. We'll also discuss the computation of the key parameters of limit order books such as spread and impact cost. Market efficiency. In this video, we'll talk about market efficiency, its three different forms, and its implications for financial markets, regulators, investors, and various other market participants. Please observe the diagram shown here. You have red curve, which is very fluctuating, which represents the actual prices which are more volatile. These are the observed prices that we observe in financial markets, while the blue one is the unobserved efficient prices or fundamental prices. What is a fundamental price? Price that captures all the information that is fundamental to the security and affects cash flow is called fundamental price. Now, the actual observed price includes all the component of this fundamental price as well as some noise or sentiment which is not fundamental to a security. Thus, actual price which is observed is fluctuating and continuously fluctuates around this fundamental price. The two price or efficient price or fundamental price is called so because it captures all the fundamental information about security. This kind of information can be macroeconomic information, information about the firm, all that information that affects the cash flows, and therefore if one discounts those cash flows, one should get that actual fundamental price. However, in financial markets, we do not observe this price. What we observe is a mix of fundamental price and noise, that is observed price equal to true price plus noise, and therefore this price is heavily fluctuating. This noise that we discussed, which is not so fundamental to a security, is many times a small and not so significant component, but at times it becomes significantly large and therefore prices become very inefficient. During these times, arbitrageurs and speculators try to exploit this inefficiency in prices and make profit. There is something called riskless arbitrage trading. Riskless arbitrage trading is there when a stock or security which is traded in different markets and that security has same underlying, a common underlying asset, maybe a company, maybe a commodity, and so on. If that security takes different prices in these different markets, for example, if it is overvalued in the equity market and undervalued in derivative market and vice versa, then these riskless arbitrageurs, traders who take counter riskless positions, that means they take long position in one market and short position in other market, attempt to exploit this inefficiency and make profits. The opportunity to make these profits is particularly high when the prices deviate too much from that fundamental efficient value. That means they deviate with respect to each other from in these markets considerably. And that is the point when informed traders, they start conducting this arbitrage activity, that is buying the stock where it is undervalued in the market where it is undervalued and selling the stock in the market where it is overvalued, and thus benefiting from the inefficiency. Because they are taking long and short position in different markets, effectively their position is riskless. Although practically in financial markets there is no such thing as riskless arbitrage, there are always certain limits to arbitrage, for example due to liquidity costs, transaction costs and taxes, etc. For this arbitrage move to be successful, this profit or inefficiency should be sufficient enough to provide or cover all these trading costs, or what we call costs of liquidity. These are like security transaction taxes, brokerage charges, and various other transaction costs. Therefore, the forces of arbitrage will work only when prices are much away from these cost of liquidity. When we aggregate all these costs of illiquidity, they create a certain window or amplitude. As long as the prices are within that window or amplitude of liquidity costs or transaction costs, there is no opportunity for these arbitrages to make profits. Only when prices deviate sufficiently away from these illiquidity costs or amplitude of liquidity and various other transaction costs and taxes, then only these arbitrages can make profit. These forces of arbitrage only work, and they work like elastic, pulling different ends of elastic when it is stretched towards its mean when the prices are sufficiently away from the fundamental value. When they are away from the fundamental value, forces of arbitrage kick in and they try to pull these prices towards that efficient price until it is back to that liquidity window. Overall, in financial markets, prices keep oscillating within that cost of liquidity window that we just discussed without these forces of market efficiency and forces of arbitrage to become effective. Only when the prices move beyond this amplitude of liquidity cost, then prices move towards this efficient price. What is this amplitude that we are talking about? This amplitude is effectively the cost of liquidity, that is aggregate of all the transaction costs and charges that are there while making transaction or trading in security markets. At times, prices move beyond this amplitude and exhibit high fluctuations. In that case, we say that prices are volatile. Generally, this happens during crisis periods or negative events of negative news when prices are too volatile and they are further away, much away from their efficient values. A higher volatility particularly means that prices have deviated or diverted from their true values. Different markets exhibit different levels of volatility depending upon the level of efficiency. It is said that markets that are more efficient, they are less volatile and prices remain closer to their efficient values. While it is said that markets that are less efficient, prices are more volatile and they are much away from their efficient values. In financial markets, we define three kinds of efficiency. One is weak form of efficiency, when a trader cannot make profit using information contained in past prices. Then the market are said to be weak form efficient. Any kind of trading strategy that is based upon past trading information such as price volume should not be profitable, then only the market is said to be weak form efficient. A market is said to be semi-strong form efficient when the trader cannot make profit using the information contained in past prices and public information as well. So the semi-strong form efficiency includes another level of a layer which is called public information. So if one cannot make profit using public information as well as past trading history such as past prices and volume, then market is said to be semi-strong form efficient. A strong form efficiency is called when not only public information and historical price data, one cannot using the information contained in private information as well. So now we have added three layers. One is past prices, public information as well as private information. If using all these three inputs one cannot make profits, then the prices are said to be strong form efficient. What should one do if market is inefficient or efficient at different levels? For example, if market is not efficient at all, not even weak form efficient, then one can make profit simply using technical trading strategies, that is making technical trading strategies using past information from prices and volume. What about if market is weak form efficient? Then one cannot make profits using past prices and other trading history data. Then one can make profits using public information. If the market is only weak form efficient, then one can make profits using public information. What about semi-strong form efficiency? If market is semi-strong form efficient, one has to use only private information because one cannot make profit using public information now. However, trading based on private information or insider trading is often not only unethical but also illegal. Therefore, this is more of a theoretical construct. Lastly, if market is strong form efficient, then one cannot beat the market whether one uses private information, public information or any other such information. And therefore, one has to stay put in the market by investing in broad market indices such as Nifty 50. The idea is that if a market is strong form efficient, then market is best judge of a company's about information, and therefore one should stay put in index like Nifty 50. In closing, to summarize, in this video we discussed what do we observe in financial markets, what is efficient and inefficient price, what is fundamental price, and what is observed price. We found that what we observe in financial markets is not so fundamental price, it includes certain noise component also. The actual fundamental price, which contains only fundamental information, is not observed. The observed price fluctuates around that fundamental price. Markets have three kinds of efficiency: weak form efficiency, semi-strong form efficiency, and strong form efficiency. When one cannot make profits using all the historical price and other trading data, the markets are said to be weak form efficient. In semi-strong form efficiency, we add another layer and say that not only historical price volume data, but also if one cannot make profit using public information, then market is semi-strong form efficient. The last form is, and the highest form is strong form efficiency. If there are three levels of efficiency, that is semi-strong, strong, and weak form efficiency, that is historical price, public information, and private information, then if one cannot make profits using all these three layers, then it is said that market is semi-strong form efficient. Risk preferences. Individuals are described by their utility functions. These utility functions describe our preferences for different outcomes. For a given level of wealth W, an individual may have the utility of wealth as UW. For all normal things like wealth, it is reasonable to assume that U-W is greater than 0, that is, for each incremental unit, more is preferred to less. This is called non-satiation. This may not be true in the case of normal goods and services. For example, after eating a certain amount of ice cream, the incremental benefit of ice cream or utility of ice cream may be negative as well. However, for wealth and money, generally the hypothesis of non-satiation is applicable. That means U-W is greater than 0. That means increase in wealth will always lead to an increase in utility, no matter how small. With this, individuals are classified as risk neutral, risk averse, and risk preferring. Risk neutral individuals. If the individual is indifferent in receiving the expected value of a gamble, for example, simple average or probabilistic average in case of different outcomes have different probabilities, or the gamble itself. For example, if you make a bet and the expected value of winning the bet is rupees 100. If you are indifferent in directly getting rupees 100 without playing this gamble, vis-a-vis taking this bet or gamble, which includes different probabilities of different outcomes, including losses, this also means that in the case expected wealth is important for you, not the variance or variability of this wealth or the risk of outcomes. Therefore, utility is a linear function of wealth for you as a risk neutral individual, and this means that U-W equal to 0. That means double differential of utility of wealth function or double differences is equal to 0. This also means that changing the risk of outcome has no effect on the utility or well-being for a given level of wealth. That means utility of expected wealth is equal to expected utility of wealth, which we'll see shortly. Then we have risk averse individual. For this risk averse individual, the utility function of a risk averse individual is concave. That means U-W is less than 0, as we'll see. This also means that the individual prefers a certain insured amount of bet or gamble with the same expected value, that is, utility of expected wealth is greater than expected utility of wealth. This means that this individual prefers a certain value over a gamble. This also means that risk averse individuals prefer less risk to more, and they demand additional risk premia to take on that extra risk. Lastly, we have risk preferring person. A risk preferring person or individual would prefer the riskier situation. His utility function would be convex, that is U-W will be greater than 0, as we'll see, and this will also mean that utility of expected wealth is less than expected utility of wealth. This we'll see shortly. However, in general, it is assumed that individuals are rational and risk averse. Just have a look at this diagram. We'll examine this in some detail. If you look at the curve of utility curve of risk neutral individual, which is the straight line, notice that for each increment, for each amount of increment in wealth, for each increment, the change or increase in the utility is same. That means delta of utility for each amount of change in wealth is same. If delta W is same, then across the wealth delta U remains same. So the double differential U double dash W, or delta U minus delta U for a change from delta W to delta W will be equal to 0. And this is what we said about this individual, that U double dash W is equal to 0. And for this individual, whether you give him the gamble or you give him the expected value in a short certain amount, it doesn't matter to him. That means utility of expected wealth of W is equal to expected utility of wealth. Now compare this to a risk averse individual for which this kind of curve is there. The curve is more concave in nature. Notice that as we give him more and more wealth, the utility of wealth U for each incremental unit is declining in nature, which means that for same amount of delta W earlier, the utility may be delta U1, and for next set of delta W, the utility may be delta U2, and there delta U2 is expected to be less than delta U1. That means his double differential of W is expected to be less than 0. And therefore, we arrived at the result that his double differential or double change in utility of wealth is negative. Contrast this to this convex kind of function here, where for this person the utility is exponentially, almost exponentially increasing, and therefore for change in wealth, that is delta W, additional change in wealth delta W, and let's say their incremental utility is delta U1 and to delta U2, for this delta U2 would be greater than delta U1, which also means that double differential of utility of wealth is greater than 0. This is for risk preferring individual because he prefers more risk to less. So if you want to take in gamble, probably his expectation of wealth or return from this gamble would be even less if the risk is more. Now let's take an example of a simple gamble and assume that there are two possible outcomes, W and W2 as shown here. Notice if these two events of wealth events of W and W2, they have 50% probability, then in that case the expected wealth EW, expected wealth, will be equal to 0.5 times W1 plus 0.5 times W2. This value will certainly lie here. This EW will be 0.5 times W1 plus 0.5 times W2. It will be somewhere midway between W and W2. However, if you look at this graph and we try to generate the expected utility of this wealth, we can easily find that on the curve for this individual. If it is a risk averse person, we can find the utility of this expected wealth to be at this point, which can be easily observed. Now for this individual, we can also find the expected utility of wealth, which is this amount, which is expected utility of wealth, which is simply 50% of UW1 plus 50% of UW2. Notice that this expected utility of wealth is somewhere midway UW1 and UW2. If I want this individual to give a certain amount for which he or she can leave the gamble, what would be that certain amount? Now it is not too difficult to find. We can find the corresponding amount matching to this expected utility on this curve, which is here, and take a perpendicular, which is CE. CE is the certain amount. If I give that to this individual, he is willing to forego the gamble. And notice the gap here. This expected value of wealth is more than the certainty equivalent. That means the certainty equivalent is less than expected value. That means in order to replace this gamble or withdraw from this gamble, I need to give him a lower amount. The difference between these two amounts, that means EW minus CE, certainty equivalent, is the risk premium that that individual is willing to give or take in order to take that risk or leave that risk. Also notice that for this utility of expected wealth is greater than expected utility of wealth for this kind of utility function, for that is for risk averse person. The more concave the nature of this curve, that is downward sloping, higher the difference between utility of expected wealth and expected utility of wealth, which is this gap. That is individual, the more risk averse he or she is, the higher this gap. Also, a sure shot payment that makes this individual indifferent between the gamble, that sure shot payment, what we are calling a certainty equivalent or CE. As can be seen here, the certainty equivalent is obviously less than expected wealth. And this difference represents the risk premia for this risk averse individual. That is, the individual is willing to take on extra risk if additional compensation is given and derive the same expected utility from the risky outcome, only if he is given the expectation of outcome a certain amount C and the gap between them is expected value of wealth minus C. This is the risk premia. Only if he is given that additional amount, he is willing to take the more risk and generate same utility. Now, look at this diagram and we can derive the implications for a risk neutral person in a similar manner. For this person, the expected value of wealth, which is this, is exactly midway, and if I drop the perpendicular here, the expected utility of wealth will be here. If I compute the utility of expected wealth, please notice because of the nature of this utility curve, it will also fall here, exactly here, because we assume that there are 50-50% probabilities of getting the outcome of this wealth W1 and W2, and therefore this value utility of expected wealth, which is similarly nothing but 0.5 times utility of W1 into 0.5 times utility of W2, will be exactly midway here at expected value of utility of wealth. And therefore we can easily say, because of the nature of this utility curve, that expected value of this UW equal to utility of expected wealth. Now let us derive the implications for risk, that is standard deviation, and return for this risk averse individual. For this risk averse investor, the relationship between return and utility will look something like as shown in the figure. More return will always have more utility, which is called non-satiation. However, for a risk averse investor, the relationship exhibits diminishing marginal utility, as we can see in this concave kind of utility curve. For example, an increase of 10% from 20% to 30% in returns here will lead to increase in 5 utility points, that is change in utility of 5 points. However, if you contrast this from 10% to 20%, this reflects a change in 10 utility. That means initially they generate a higher change in utility, a higher increase in utility, but as more and more wealth is generated, the utility is decreased. The chances are that this is happening because in order to generate or find additional return, the fund manager or portfolio manager may need to take more risk or find opportunities that are difficult to find or not so easily available, and therefore more risk is desired. And because of that additional risk, the utility of that same amount of wealth is lower. Look at this indifference curve for different individuals, U1, U2, U3. These are indifference curves for individuals, and for each of these individuals, as we can see, U3 is greater than U2 is greater than U1. That means as we are moving up on the indifference curve, that is increasing the level of risk, it would require also increasing the level of expected returns to maintain the same level of utility. Notice this, the nature of curve, it is increasing. So when we are increasing the risk in order to maintain the same utility, because we are on the same iso-util curve U3, we need more returns. This is certainly a person who is risk averse. He wants higher return for increasing risk. Contrast this to U4, which is a horizontal line. For this kind of individual, the utility remains the same despite the increase in risk. That means he is indifferent to increase in risk and his utility is same as long as the returns remain the same. And therefore, this kind of individual would be called a risk neutral individual. Now let us have a look at this another individual. For him, the risk versus return plot is like this. It's downward sloping. The iso-util curves u1 and u2 are downward sloping. That means for increasing risk, his utility remains same with lower returns. That means this person is more of a risk-loving, risk-preferring person. So when he is given more risk, he is even satisfied and generates same utility if the returns are lower. And look at his utility versus return or wealth diagram. It is upward sloping, which clearly suggests that for him, additional utility of wealth with increasing wealth is increasing exponentially. And therefore, this kind of person, probably he is more risk-loving person, because additional opportunities for wealth are difficult to come by, and the portfolio investor or portfolio manager needs to take more risk to generate the same amount of wealth. And this person, when additional amount of extra risk is taken to generate same wealth, probably he is more happier and therefore his utility is increasing. That means his u double dash w is greater than 0. So this is a risk loving or risk preferring person. To summarize, in this video we discussed that individuals are classified based on their utility functions in 3 types. First, risk averse individuals. Individuals who prefer less risk to more, and therefore in order to force them to gamble or take part in risky events, some additional compensation is required. Next, we discussed another class of individual called risk neutral individuals. These are the individuals who are indifferent to risk, and therefore a gamble for which certain expected wealth is given with certainty or through gamble, they are indifferent to taking gamble or taking that sure shot outcome. The third class is described as risk loving or risk preferring person, and they are willing to take a gamble with even lesser amount of expected wealth as compared to a sure shot amount of wealth which is same as this expected wealth. Types of markets. In this video, we'll talk about different types of markets, market microstructure, and their implication for various market participants. We begin with conventional broker-dealer markets, or often referred to as code-driven markets. The conventional markets were often referred to as broker-dealer markets or code-driven markets. These markets involved brokers who routed the orders of their clients to the exchange in lieu of certain brokerage. More importantly, these markets involved dealers who were engaged by exchanges to make a market in a given set of securities, for which these market makers will also be called as jobbers or specialists. Therefore, they were also called as designated market makers. These dealers provided continuous liquidity to the market in the form of continuous buy and sell sided quotes, and that is why the name quote driven markets. They charge a certain ask price to the incoming buyers and offered bid price to incoming sellers. The gap between ask and bid prices, also known as spread, is the profit to these market makers. This process of offering both buy and sell sided quotes is often referred to as liquidity provisioning. Thus, these market makers ensured that a well-functioning market is made in a given set of security so that incoming buyers and sellers would feel confident about their ability to trade in that security. Importantly, the spread reflected a very important dimension of the market for any security, which is called liquidity. Essentially, liquidity is the ability of a trader to trade large volumes of quantity in a very small time frame with incurring the least transaction cost or least impact on prices. If there are a large number of buyers and sellers in a security, that means trading is taking place in large volumes. It is expected that such security will have low spread. This is so because the market maker can charge lower spread and still make a sufficient amount of profits to cover his costs. What are these costs? We'll have more to say about this in subsequent discussions. Such market is often referred to as deep and liquid market. Prices observed in such markets are expected to be more reliable and efficient. Contrast this with a market where trading volumes are very low. Spreads are expected to be higher in this market. Moreover, this market is expected to be shallow and less efficient. Prices prevailing in this market are expected to be less reliable and less efficient and much further away from efficient prices. Also, the market maker may charge a higher spread in this market to cover his costs. For example, consider the figure shown here. We have two markets, one where 5 lakh shares are traded at a price of 150 and one where 10 shares are traded at a price of 100. Which one would you consider least reliable? The answer is quite obvious. Where only 10 shares are traded, any incoming trade at even substantially different prices like 20 rupees or 30 rupees or closer to 100 would change the price. It does not require too much quantity because already a very small amount of shares are traded in this market. In contrast to the other market where 5 lakh shares are traded, in order to change or substantially shift the prices, a sizable volumes of trade is needed to do that. And therefore, the prices that are prevailing in market where 5 lakh shares are traded will be considered as more reliable and more efficient. Now, this market maker will charge a higher spread in a market where there are much less shares available because his profit for per trade is much less, and therefore he would need a higher spread to compensate for different costs incurred by him in this market making activity. Also, therefore, this security where there are less shares are traded will be called less liquid because not only there are less number of shares, spread is higher, and therefore it will have a shallow market. As of now, we are yet to unravel what are these costs for this dealer for which he is charging this spread. Why is he charging this spread? The another type of market microstructure is limit order books. Unlike the code-driven markets or broker-dealer markets we have just discussed, these order-driven markets do not involve these designated market makers. These are run based on electronic limit order books, and they predominantly involve two kinds of orders: limit orders and market orders. In these markets, these limit order suppliers act as liquidity suppliers, and therefore they are often referred to as de facto market makers. These limit orders, they reside inside the limit order books. These are electronic signals and patiently wait for incoming market orders for execution. In contrast, market orders, they consume liquidity and they are executed as soon as they are transmitted. And therefore it is said that market orders consume liquidity which is provided by limit orders. Another type of classification is primary versus secondary markets. New issue of securities take place in primary markets, for example, IPOs or issuance of fresh government securities through auctions. These are called primary market trading. Securities that are already issued in primary markets, their trading takes place in secondary markets at exchanges. This is only for the purpose of nomenclature. There is no such physical space or market as such. It is only based on the mode of trading. For example, in India, fresh auctions of RBI would be called as selling in primary markets, while secondary trading will take place exchanges. It is desired that we have deep and liquid secondary markets to create appropriate environment for primary issuances. So it's like a chicken egg problem. If there are no good secondary markets that are liquid and deep, probably issuers would not be looking at such markets for primary issuance in a favorable manner. Next, we have call and continuous auction markets. The normal trading hours in which trading takes place at electronic limit order books, a continuous kind of matching of buy and sell orders takes place. This is called continuous order matching or continuous auction markets. In this kind of market, there is a continuous trading and continuous matching of buy and sell orders. In call auction markets or call markets, trading takes place at certain intervals. In this, individuals have the option to send their orders, and also in a certain period they can revise, modify and cancel their orders in a certain window, after which the orders are matched, like batch auctions. One such example of this kind of batch auction or call auction is pre-open session as National Stock Exchange of India, which follows the call auction framework. All global markets employ some kind of call auction framework at opening and closing sessions for efficient price discovery. At NSE, there is a session that has a duration of 15 minutes. During the first phase, from 9 o'clock to 9:08, this is called the first phase, one can submit orders, limit orders, and revise, modify, and cancel them during the first 8 minutes of trading, that is from 9 to 9:08. After that, orders are matched and price discovery takes place. The prices at which maximum amount of trading takes place is considered as opening or clearing price. Often this price is considered to be more efficient as it incorporates the information of large number of market participants. This is the price at which shares are allotted in pre-open session. This facility is provided to safeguard the interest of uninformed traders from being picked off by more informed traders. This may happen because there is a lot of information accumulation over the overnight period. This is due to the fact that there is a lot of information accumulation at overnight period when trading is not taking place. These uninformed traders may not have a fair idea of this information and may place poorly informed orders and make losses. This is unlike prices during the day when trading is on. During the day, any new information is incorporated in prices very quickly through trading activity, and therefore prices are considered to be rather efficient. Hence, the probability of uninformed traders being picked off by informed traders and making losses is very low. Let us discuss an example of this order matching and price discovery in pre-open call auction as discussed here. Notice the price schedule. So we have a share price schedule which is provided in the first column here. We have accordingly the buy and sell order book built up here. Now looking at this buy and sell order book, we can estimate the demand for given buy quantities and supply for given sell quantities. We can estimate that. How to do that? For example, if you want to estimate the buy schedule at 103 rupees, notice almost all these orders on the buy side would be willing to buy at this price, and therefore their cumulative buy volume is provided here. If you are looking at 104 rupees, starting from this quantity and all the other higher quantities would be available to buy at this rupees. Conversely, if we are looking at 108 rupees, all these sell orders starting from this one, all these sell orders will be willing to sell, and therefore supply is the accumulated order here. Similarly, if we are looking at the supply at 107, starting from 11,500, 9,800 and so on up till 12,500, all these orders will be willing to sell their orders at this price. And thus we can prepare demand and supply schedules at all the prices. Now, if the matching takes place, the price at which maximum quantity is traded will be considered as the opening price. If we notice in this case, at 105 rupees, maximum order quantity can be traded, which is 27,500. And therefore, 105 will become the clearing price and opening price for the session. Thus, we arrive at the maximum tradable quantity. You may ask, why not based on maximum revenue? From market efficiency perspective, it is important that maximum people, maximum market participants engage, and therefore fair and efficient prices emerge. For this to happen, maximum tradable quantity, or the price at which maximum quantity is traded, that should be selected, and based on that logic, this 105 rupees is selected as the opening price because at this price maximum quantity is traded. To summarize, in this video we discussed different market microstructures. We discussed conventional broker-dealer markets where there was a central designated market maker entity which provided continuous buy and sell side liquidity and ensured smooth functioning of the market. We also discussed limit order books which run on electronic limit orders and market orders. These limit orders provide liquidity which is consumed by market orders. We also discussed continuous markets which are like limit order book electronic markets which run continuously by matching buy and sell orders. Then we also discussed call auction markets or batch auction markets where trading or matching of order takes place over certain time horizon or intervals or time window. For example, National Stock Exchange of India where call auction takes place from 9 o'clock to 9:15. We also discussed primary versus secondary markets. Primary markets are markets where primary issuance of securities takes place. Those securities that are already issued in primary markets, their secondary trading takes place at secondary markets. Theoretical underpinnings. In this video, we'll talk about three types of traders, that is noise and liquidity traders, informed traders and market makers. We'll also discuss two key theoretical underpinnings, that is inventory hypothesis and information asymmetry hypothesis in the context of market microstructure. To begin with, there are broadly three kinds of traders in the market. Financial markets are characterized into three classes of traders. First is noise and liquidity traders. Noise traders are those who do not have the proper information. However, they believe that their information is recent and they want to benefit from this information. Since the information is stale or incorrect, their trade contributes in the form of noise in prices. Next, we have liquidity-driven traders that trade to obtain liquidity from financial markets. Again, they do not have any new or fundamental information, and their trades do not contribute to information but put noise into prices. These traders constitute a majority of trading, that is, noise traders and liquidity traders, they constitute majority of trading volumes and they are essential for trading to take place. Next, we have informed traders. These are generally large institutional investors who spend a considerable amount of money in the acquisition of information, resources, and analysis. As these traders detect an opportunity to benefit from inefficient pricing, they exploit this inefficiency using this information and analysis and trade in large volumes. While these traders comprise only a small fraction of financial markets, their trading activity heavily contributes to the market in increasing their pricing efficiency and informational efficiency. We must note that any trader, informed or uninformed, instills his or her information into prices through trading activity, particularly when he or she conducts large volume of trades. Since these informed investors or traders have correct and appropriate information to exploit inefficiency in the prices, their trading activity incorporates this fundamental information in prices as they trade in large volumes. Next, we have market makers. As discussed already, a market maker is somebody in the market who offers continuous buy and sell sided quotes and ensures smooth functioning of the market in that particular security or set of security in which he or she deals with. In other words, this market maker provides liquidity to financial markets. It may be noted that he buys the security at bid price from sellers and sells the security at the ask price to buyers. The gap between this ask and bid prices is the profit to these market makers. In order to continuously provide buy and sell sided quotes, this market maker has to maintain a certain optimum level of inventory. The inventory should not be too large or too small. At times, there is a dominance of buy or sell sided trades which may cause deviations in his inventory from optimum levels. In order to achieve those optimum levels, this market maker adjusts his or her quotes to nudge the order flow so that optimum levels of inventory are achieved. Also, this market maker tries to gauge the probability of information event through the intensity of buy and sell sided trades. This is so because he or she incurs losses in trades against more informed traders. Therefore, depending upon his or her assessment of the probability of information event, market maker increases or decreases the spread charged by them. While the market maker incurs losses against the trade with informed traders, they compensate themselves through higher spreads charged in all the trades and averages out the losses. Literature on market microstructure and market efficiency comprises two broad theories related to the cost of market makers. First is inventory considerations. Market makers maintain a certain optimum level of inventory as we discussed, and therefore they are exposed to fall in security prices. They may have to liquidate this inventory of securities at lower prices than they were purchased. Maybe they were purchased at higher prices. To account for these losses, a certain component will be charged in the form of spread. Next, we have information asymmetry hypothesis. There is a certain probability that the counterparty against market maker will be more informed. Market makers incur losses in such trades. Based on their experience, market makers will have a certain estimation of information events, for example, through examining order imbalances on buy and sell sides. Based on this, they will have certain estimate of losses, and to cover these losses, they will charge a certain extra component of spread in all the trades, since they cannot identify who is the informed trader and who is not. Market makers keenly observe order imbalances, as these order imbalances affect their inventory from optimum levels. These order imbalances can be caused on account of sentiment-driven noise trading and informed trading. If the order imbalance is caused by sentiment-driven noise trading, such imbalances are expected to be temporary. Market makers adjust their quotes in temporary fashion to absorb these imbalances. Once these order imbalances are absorbed, the quotes revert to their original levels. In contrast, order imbalances driven by informed trading are more permanent in nature and therefore the quote adjustment made by market makers are more durable and permanent in nature. Order imbalances can be easily measured with the formula provided here. Order imbalance equal to buy orders minus sell order divided by buy order plus sell order. Here buy minus sell can be in terms of simple share volume, dollar rupee volume, or number of orders. To summarize, in this video, we discuss three classes of market participants. First, noise and liquidity traders, whose trading activity incorporates noise into prices. Then we discuss informed traders. These are large institutional investors and they have some kind of updated information and their trading activity leads to more efficient, informationally efficient prices. Third, we discuss market makers whose responsibility is to provide buy and sell sided quotes, and in order to cover their market making cost, they charge a certain extra spread between buy and sell prices or bid ask prices. Then we discuss two key theoretical underpinnings. One is inventory hypothesis, which suggests that because of their inventory levels, market makers charge a certain extra spread on account of their inventory costs, and quote adjustments on account of inventory hypothesis are more temporary in nature. We also discussed information asymmetry hypothesis, wherein we said that these market makers often incur losses in their trade against more informed traders. To account for these losses, they also charge another certain extra component of spread. The adjustment in quotes, bid and ask quotes on account of information asymmetry hypothesis are more permanent and durable in nature. Rise of machines, limit order books. In this video, we'll discuss a very important market microstructure, which is electronic limit order books. Unlike quote-driven markets, order-driven markets like India lack designated market makers. These markets run predominantly based on two kinds of orders, that is limit orders and market orders. Here, the limit order suppliers act as liquidity providers because these are patient orders that sit in limit order books, and often referred to as de facto market makers because they are not specifically engaged by exchanges, but they are individual orders, limit orders that are sitting patiently in the limit order book waiting for execution, and in that sense they provide liquidity to incoming market orders. Market orders are considered to be impatient. They, as soon as they arrive in the order book, they demand liquidity, they want to be executed. This liquidity is provided by limit orders. So in a sense, these market orders consume liquidity provided by limit orders. A market order is a rather impatient order which directs the broker or online brokerage houses to buy or sell security at the best available prices. What is this best available price? We'll have more to discuss about this, but for now, whatever the best possible terms and conditions in terms of pricing, these market orders are executed. So for example, there is a set of ask prices at which investor can buy the security. Of course, he will choose the lowest ask to buy the required security. Similarly, there is a set of bid prices at which investor can sell the security. However, he will choose the largest bid price to sell his security. Coming to the limit orders specify the worst acceptable terms. For example, a purchase sell 100 shares of company A with limit 1000. So the broker should not pay or receive anything more than or less than rupees 1000. The unexecuted limit orders are inventoried in the order book till the time they become best orders and are picked by incoming market orders or marketable limit orders. At the closing of the day, unexecuted orders are often cancelled unless specified otherwise. The most favorable ask order, sell order with the lowest price, is referred to as the best ask order, and the most favorable bid order, buy with the highest price, is referred to as the best bid order because of the reasons as we discussed earlier. The difference between these ask and bid is called the spread and is an important measure of liquidity. The investor who makes an immediate buy and sell transaction through market order will incur this spread. Let us examine a limit order book snapshot at a point in time as shown here. Notice on the ask side, the lowest ask price is L1 ask. This L1 ask will be referred to as best ask price because incoming market order to buy will find this order most lucrative or best in terms of conditions. So incoming market order to buy will first execute against this A1 quantity, which is the depth of this order book corresponding to the best ask price. If there is further some amount left for the incoming market order, then only it will have a look at L2 ask. Similarly, the incoming sell order will find the L1 bid price, incoming market order will find this L1 bid price most favorable, and therefore it will execute against this 248 rupees at quantity B1. So B1 is the depth of the bid side. Now only if this B1 is exhausted, then the incoming market order to sell will look at this L2 bid, and so on so forth. The bids and ask side is exhausted and matched against incoming market orders. As we discussed, a very important dimension of liquidity is the spread, which is the difference between these best bid and ask prices. However, across stocks with different sizes, this absolute spread may not be comparable, and therefore it is scaled by dividing it with mid price. In this case, mid price is 249 rupees. If we divide this 2 rupee by the 249, we get something called relative spread or ratio spread, which is 2.249. It is a very important measure of liquidity because it is properly scaled, and therefore it can be compared across different stocks as well. Unlike code-driven markets, these markets do not have designated market makers. Hence, these limit orders act as liquidity providers, which is consumed by market orders. Therefore, these limit orders are also called as de facto market makers. These order-driven markets operate as electronic markets and also employ algorithmic trading. Algo traders execute orders at frequencies as low as microsecond. Huge amount of investments like millions of dollars in network connections is made in the market infrastructure to gain an advantage of just few milliseconds. Given the speed of these orders, these algo traders impact prices at an extremely fast pace. Any inefficiency in prices is exploited by these algo trades at extremely fast pace, and therefore prices become efficient within a window of very fraction of seconds. Therefore, the window of efficiency has come down drastically, and this has led to a debate of man versus machine, that is, whether it is fair for human traders to participate in trading against these algo traders. A large number of algorithms are available in market to exploit various kinds of inefficiencies in prices. Incoming orders, incoming limit and market orders are rated based on their time price priority. So, in order book, any incoming order is compared or considered in sequence based on how favorable it is in terms of prices, and if prices are same, it is compared in terms of time. So if, for example, here on the ask side, the two orders, that is 95 rupees, both of them are there. So while in terms of prices, both of them are equally favorable and best in this order book, we have to go to their time, and it appears the first, this is 12:10:40, this order has come earlier, and therefore it will be considered as the best order. Similarly, on the bid side, notice the price at the highest price at 98, since there is no other order at 98 rupees, this 98 rupee limit order will be considered as the best, and 90 rupee, which is the lowest price, will be considered as the worst. Also, a very important dimension of order book is impact cost, is the impact of its own trade on prices. So if a large trader comes to market, his own trading activity will shift the prices whether on ask side or bid side, and it will affect the prices. So let us examine how to compute this impact cost. The formula to compute impact cost is quite simple. What we need to do is we need to compute the weighted average buy or sell price. We can compute the impact cost on buy side as well as sell side. So we can compute the weighted average buy price. For example, whatever amount of trades on buy side, their weighted average price divided by the mid price. We already know how to compute mid price, which is the average of best bid and ask prices, minus 1 will give us the impact cost measure in ratio terms. We can convert it into percentage as well. Let's take an example. So using the given data, as we can see here in table, we can arrange the prices as per their priority based on the time price priority, as we discussed already. So it will appear something like this. Now NSE defines a very simple measure of impact cost as the change in prices for 1 lakh rupees worth of trade. So using these orders on both sides, ask and bid side, we'll have the price as well as quantity. We need to establish how much trading has to take place in order to exhaust 1 lakh rupees worth of orders. So we'll compute the cumulative orders, and here we can see the cumulative order computation. For example, if this first order is fully exhausted, trade worth 20,900 will take place on the ask side, and so on and so forth. Next is 19,000, and until we exhaust the trades worth 1 lakh, we'll stop here. Similarly, on the bid side, we also again see that at this fourth order, 1 lakh rupees worth of trade are exhausted. So we'll compute the volume weighted average prices using the price information here and volume information here. So this will give us the volume weighted average price on the ask side. Similarly, we'll use the price information here and volume information here to compute the volume weighted average price on the bid side. Now, very simply, these volume weighted average prices will be used. So this is our volume weighted average price on the ask side. We'll divide this price by the average, which is on both sides. The average is 95 plus 94 divided by 2, which is 94.5. So we'll divide this price by 94.5 minus 1. Similarly, on this side, this is the weighted average price. Since this is less than mid price, our measure is negative. We'll divide this also again by 94.5 and subtract from 1. So we'll get in percentage term minus 2.02%. Of course, since this volume weighted average price is less than mid price, the value is negative, but we are more interested in magnitude here. Another important and interesting terminology here is stop loss, buy and sell orders. We'll discuss this and close the video. So these orders are executed and activated when the price of the security reaches some predefined limit. This is like a limit order which gets converted into a market order as the limit is reached. For example, a stop loss sell order at rupees 40 will become a market order to sell if the price trades as 40 or below, and vice versa for a stop loss buy order. These orders are used to lock in a gain or limit a loss. For example, if I purchased a share at rupees 60 and now I want to profit from price rises, and I'm hopeful for the same. However, I also want to ensure that my losses are limited, although I feel there is a very low probability of fall in prices, but who knows. So I place a stop loss at rupees 40. That is when prices reach 40 or below, a market order to sell is placed immediately. To summarize, in this video, we discussed a very important market microstructure, which is limit order book, which runs on electronic orders of market orders and limit orders. Market orders are executed immediately at the best available prices, while limit orders await patiently in limit order book for execution against incoming market orders or marketable limit orders. Lastly, we also saw the time price priority rule of limit orders execution, and we also saw the computation of impact cost for bid side and ask side. To summarize this lesson, financial markets provide a very important conduit for individuals to optimize the time pattern of their consumption. The demand and supply of funds determine the efficient clearing prices and therefore the interest rate environment that prevails in the economy. Expectations of interest rate from security are determined based on the risk of the security. Risk of a security represents the increased uncertainty in outcomes. The wider the possible outcomes, the more the risk. For a given level of risk, investors prefer instruments with higher expected returns, and for a given level of expected returns, investors prefer instruments with lower risk. We discussed the computation of standard deviation and variance, the two most important measures of risk in finance. We also discussed the properties of normal distribution, which is most often employed in modeling the financial market returns. Lastly, we also discussed the concept of interest rate compounding.